Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we are going to get into essentially what is part two of our Fannie Mae training. And today, we're going to actually do some really cool stuff, including running DU. But we will wait just a few minutes here to get started, let everybody have a chance to jump on, and let us go live on all the different platforms. You can go ahead and drop a comment there in the chat in the meantime while we go live on all the different platforms. I see some people are already dropping comments there. We appreciate it. And we look forward to a great training here tonight. Just give us a moment to go live on YouTube, Facebook, Instagram, and LinkedIn. And we do this show every Tuesday and Wednesday night at 7 p.m. Eastern. And it looks like we are good to go. We got live on all the different platforms, so we can go ahead and get it started. We'll take the chat off the screen there. So welcome, everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. And every Tuesday and Wednesday evening at 7 p.m. Eastern, we do this loan officer training series where we go through training on different types of loans and how to do loans for the loan officers out there. Now, last night we went through some Fannie Mae DU results, and we were reading those results. And tonight we're going to kind of continue along that line. And Jose is actually going to run DU, going to kind of set up an application and run DU, and we will go through it. So he's going to do Homer Loanseeker, which is a test file. So this is not a real person, but it is a test profile that we are able to test when running DU. So I will let you go ahead and take it over from here, Jose.
Good evening, everybody. Great to be with you tonight for our second part of DU, automated underwriting, and specifically Fannie Mae, which would be desktop underwriting if you're a broker, desktop originator if you are a lender like we are. Now, in yesterday's training, we basically just went through reading the whole report and what it entails, talked a little bit about what it is. But here we're actually going to get into the meat and potatoes of how we get there. Now we're dealing with Homer Loanseeker. He's an amazing guy, but his credit is not as amazing as him. So let's see how we get there. Actually, I think it would be a good idea to review his credit a minute, just so that we can have an idea. Normally, this is what we would do, right? We would review the credit and see if we're going to stand a shot. And then
again, this is fake, everybody.
Yes.
So this is the Fannie Mae fake file that they let you test stuff with. So
yes,
this is also fake credit.
Correct.
But
this is not.
It looks real.
All right, let's let this open up a minute here. Let's bring it back over here. And let's see what we're dealing with, right? So scores are 636 middle score, but let's see what we're actually dealing with, okay? I mean, he has a mortgage, installment, he has a car, a pretty cheap car payment, and he has a secured loan. He has some closed accounts. No lates there. So far, so good. And he has two recent collections.
I see a lot of red over there.
Yeah. Oh, yeah.
In the last couple accounts there.
Yeah. I guess why wasn't it brought down to the derogatory? So, that threw me off. But yeah, we have installment loan here. Looked like it had some a 60-day late and a 60-day late in 2020. Then we had another installment loan also, 60-day lates, and then we had some 90-day lates recent. What a shame, November of 2022.
That's the one that's killing you there.
So let's see. I mean, we'll see what we can do. I mean, he definitely wants to go conventional. That's his preference. And then we have here some collections that have they're paid collections, but they were June of 2022 and May of 2017. Right. So we'll see. And he has some public record stuff. Some, all right, but that's dismissed kind of stuff. But here is the worrisome part, these recent 2022 stuff. Okay, so that's what we're dealing with there. So let's go back now that we know the credit profile. So, what we did here, we just went and set up the file completely, right? So this is a conventional fixed rate. We have our loan template properly set for a conventional loan, for a conventional fixed rate, primary purchase, $700,000 sales price. He's given $200,000 down. So we're at a 71.429% LTV. And our DTI, our housing expense is 22.712. And our total debt is 26.439. So those are good numbers. And I also know that he has good money in the bank. So we'll get to that in a minute. So we're dealing with a detached property, single family. So he's individual, unmarried, currently living in Arizona, but he owns an investment property in Miami, and he's buying this other property in
See
Miami
if you
as
can
well.
zoom in a little, Jose.
Okay.
Hold
How do I do that?
Hold control and then use your mouse scroller. Is how I do it usually.
Okay.
The other way.
Here we go.
And it should pop in a little bit.
And okay, I'm still in the same. Is that better for?
A little bit, yeah. You can maybe go a little further,
right,
but yeah, it's a little better.
All right. How about that? More legible?
Yeah.
All right.
Yeah, that was good.
All right.
Better for sure.
All right. So currently he's Arizona, but he's relocating to Florida. He likes it so much here. He has the investment property. I already imported his credit report into the file. Here is our 3 credit scores, our credit reference numbers, really important because automated underwriting needs to have that information inside the system. So let's go a little bit further. Our subject property information is right here again. And here's another little recap of the deal. 6.5%. He's doing some buy down there. And again, this is a recap of what we saw. And look at the kind of income. I mean, he's really good. He's $18,000 a month. So we got that low DTI. Subject property information here already. Scroll down a little bit more. His name right there, Homer Loanseeker. He's taking sole ownership. Fixed rate, first lien. 4260.34 is our total payment with $700 a month in taxes and $400 a month in insurance. All right, so let's keep going. His cash to close is $227,883.41. He has not had any counseling, neither in person nor web based, in the past 12 months. And his currently resides, like I mentioned, Arizona for 2 years, so we do not need to verify any former address. His mailing address is the same.
Can you click the little housing box, Jose? A lot of people miss that. So
Right.
you did it easy there with the rent, but if it's not real easy where they're renting and you need to actually, they're doing a rental property or something, you got to actually fill that part out that Jose's rolling over right there.
Especially for, if it's an investment property,
because you got to have their current, their current primary needs to be listed there. So sometimes it'll import automatically, but make sure you double check there. A lot of times I see that missing, right, Jose?
Absolutely. Right. Keep on going. Mailing address. He's not in the military, nor does he have any prior military service. All right. He works at Happy Place USA, and his position is the boss. I didn't put him as self-employed. I just thought it looked cool to put the boss. So $15,000 a month. He's making some good money. Now, if you look over here at the, you get down here, you're going to see other income. That's from the investment property that he owns. That I'll show you that right now. So he has a good amount of money, $400,000 he has in the bank. And you saw it was like 227 what he needed. These are.
Can you do me another favor, Jose?
Yep.
Can you put an earnest money deposit in there?
Okay, so let's put that there. Let's put that there.
A lot of people miss this. Make sure you put your earnest money in there if you want it to show up on your loan estimates and stuff. So thank you.
Right. All right. Now those are his accounts. Doesn't have any other liabilities. Now this is his investment property. It's Miami property, and wait a minute. Here we go. So he only owes $92,000. We did match the asset to the liability right here. And we take this information from his tax returns. This would be on Schedule E. This would be the rents that he received. And typically we're going to start with a 2-year average unless we get a 1-year finding in the DU. Then we only need to use the current year, which would be 2022. So this would be the average of the 2 years of the rents received. Keep in mind, you can't average a higher number, a higher 2021 with a lower 2022. So we're assuming here in our example that it was something that we would be able to average. And we're also assuming that he is escrowing for taxes and insurance in his payment. And here the $850 is just additional expenses that are on the tax return. If he's escrowing for taxes and insurance, we're going to add those back so we wouldn't double dip him on the expense. Depreciation is added back, but they always put other expenses, repairs, maintenance, so forth, management fee. So that's what it added up to, $850. This is a seasoned rental, so we're going to give him 100%. And we're assuming he's the only owner, so he also gets 100% of the income. So as you see there, $37.58. That's where that number is the one that transferred to his other income that you saw on the income page there. So this is his only property. So we're going to close that up here. As you can see here, no other property. It's really important when you're running these reports that you make sure that there aren't any of these entries like that. This little X here isn't black. If it's black, that means you got a blank entry there and it's going to give you an error. Another thing to look for that, because sometimes customers start putting stuff in the application, it transfers through when we import it. Sometimes.
Yeah, why don't you make one real quick, Jose? Show them what it looks like.
You mean like the?
Just make a blank. Yeah, just type something in and then delete it. And so a lot of customers will often try to type it in and just type in one field or something like that. So
you see how when I do that, all of a sudden this is active, and then if you come here. You see, you can't see them.
Yeah, but it's real hard to spot sometimes.
But there's 2 little dots right here. So if you can go like this and you see the blue bar there, that means it's picking up like that's supposed to be something there, right? So a lot of times you may get an error when you're running the DU that there's a property disposition. And you know what, Nick? I'm going to leave. Well, if I leave that there, it won't let me run my report. But just so you know, well, actually, you know what? I will leave that there, and then we'll go back to it. So I'll let everybody know how to, because that's an error that they get quite a bit, and they can't figure out how to fix it. So we'll leave that there for now.
Cool.
And then here again, this is just a lot of recapping going on here, a lot of redundancy in the system. But notice, no other new mortgages, no HELOCs or anything like that he's applying for. So I click does not
Note
apply.
that manufactured, we've done quite a bit of manufactured lately, guys. And obviously we do conventional often for manufactured. Last couple we did were that. So make sure that gets checked.
If it's a manufactured home, do that. If not, make sure it says site built here. And then he's not going to get any rental income. This is a primary residence, so clicking does not apply there. He's not getting any gift. He has $400K in the bank. Does not apply there. Very important also that will you occupy the property as your primary residence? Make sure that that says yes if it's going to be a primary, because it could be primary on the first page, but if you don't have this checked, the system may not, won't pick it up, and then it's going to hit you with that rent into your DTI. It's going to throw it in there. So then, yes, so I got to, answer these questions, all the stuff in blue you got to answer. So all of my declarations are properly answered. All the stuff down here that they need to put. Now, my home counseling stuff, this would be more if we're going to disclose it, but I'll just go ahead and do that to let you all know that when you're setting up your file, after it's already approved, you want to make sure that you gather up the agencies there. Now let me go a minute to the LE. Want to make sure, well, it's taking a while, make sure that the deposit is showing up. I think it's going to be on page 2. Yep. So right there, deposit $5,000. So I want to make sure it's going to show up. So I think let's go a minute to the fee sheet or itemization. Make sure we have the correct template. So it is set up for conventional closing costs, conventional fixed rate. We have our conventional fees there. Everything is set. I got my insurance for 12 months. My aggregates set up. Now, keep in mind with the aggregates, when you get the pre-CD from the title company, that's actually going to do the closing, because I loaded up the Lodestar fees here is what I loaded up. That's what we disclose these files with. But when you do get the actual pre-CD from the company doing the closing, there's going to be a tax proration, right? And then that tax proration is going to be input depending what it is. If it's a adjustment for items that the seller already paid for, the seller is going to get a credit, so you would want to put it here. And if it's adjustments for items unpaid by seller, which is usually what it is, they haven't paid the 2023 taxes, but they're responsible for January 1st through whenever the closing date, that would be on the pre-CD from title. You'd put the dates here and the amount here, and that's going to put it as a credit to, defer a little bit of that expense. I mean, with Homer Loanseeker, with all the money he has, it's not going to be an issue. But if you're in a deal where you're that close to the borrower, then you may want to reach out to the title company and get that tax proration figure so that you can offset this 12 months. Because that will normally be roughly 3.5 to 4 months, depending what day of the month you close out on. That'll be the borrower's actual out-of-pocket responsibility. The balance will be paid by the seller, but will be offset by the tax proration credit. So this would stay as 12, but then the tax proration credit will offset about 8 months of this. So if you're that close, again, make sure that you get that.
So you're talking about to get approved eligible, right?
Well,
you could be approved ineligible because you might not have enough money.
Correct.
And that's going to fix that problem. So we're talking about still fixing the DU here pretty much.
Correct. Yeah, just, I mean, if you're dealing with a borrower that, I mean, once you do your reconciliation and you come down here and you're like, oh my God, my borrower is short by $4,000. Well, that tax proration credit is 8 months times $700 is $5,600. That would make up the difference. So now the moment of truth. Let's go request underwriting here. Now, everybody remember, this is not a real file. This is not real credit. But it is data that the system is going to really interpret. All right, and away we go. I have my doubts though on Mr. Loanseeker. Let's see, because if not,
with what was that, like 35 late payments in the last year? That's a little crazy.
Within the last 9 months, he had 2 accounts 90 days late. That was a big issue.
I saw 17 though. There were 17 30s, like 660s, and 290. That's crazy.
So this is why it's so important. What happened? Oh, okay, this is our little error here. Now notice it says, oh, well, you guys can't
double click it so it opens a little bigger. It'll open like an actual, and then you can open that bottom, in the bottom right, you can drag it. The bottom right will make it, there you go.
This
is what hard for us to read it, but at least.
Well, this is what I wanted everybody to see, though.
Yep.
Well, I guess it doesn't say it here. Oh, yeah, right here it says, owned property disposition is missing. Status in parentheses. So we already know what that is, right? So let's go back to the loan. And we get this call all the time from MLOs. What is this error? So now we know we got to go to the VOM section. And we got to clear out that entry. So right there, boom. Hurry up, Encompass, there you go. So now we will go back. Request underwriting. And it's always submit to DO for EPAS because we are lenders.
Any brokers out there watching this, do you same thing?
And normally this transfers the password direct, but I had to input it manually today. Drum roll, everybody. Is it going to happen? See, this is why it's so important to do this for pre-approval, because we get people to ask us all the time, can't we just issue a pre-qual letter? I mean, come on, the DTI is 26, the credit score is 636. Fannie Mae will accept it, but then we get refer with caution. It's like, oh my God, what happened? So let's start looking through this, right? Because everything looked beautiful.
So hold on, what does refer with caution mean?
Refer with caution is the worst one you can get.
That means denied in a nice way.
Yeah, you're not even refer eligible. You're not approved ineligible. No, you're refer with caution. They're like, stay away, from this deal. All right, so let's start looking now. They're telling us all over now. So at first, we ran this preliminary, which is what we would always do the first time around. But then is letting us know it does not meet Fannie Mae's eligibility requirements. It is ineligible because it received a refer with caution recommendation. Now, this paragraph here, it says refer with caution recommendation may be manually underwritten in accordance with the selling guide, but I don't know of any conventional investor out there that does manual underwriting on a conventional loan. Haven't found one yet. Now, here's where we get into finding out. They're going to let us know the following aspects of the borrower's loan application had a negative impact on the recommendation.
So again, hold on. What are we seeing here?
Well, I'm trying to see if I can do your little control thing here to make this bigger. No, not for this page. Nope.
But it's literally telling us what here again?
What is
highlight that part at least if we can't zoom in the negative
credit? Well, it's telling us the following right here.
That one.
Right, that right there. So the following aspects of the borrower's loan had a negative impact on the recommendation. Right. So, and then it's telling you additional information about each of these risk factors can be found in the lender guide for use with applicants section of this report.
So when an MLO says, why is it not approved? It tells you exactly why it's not approved.
And here it gets into the specifics. The following items in the borrower's credit report had an adverse impact on the borrower's credit profile. Additional information about all of these risk factors can be found in the lender guide for use with applicants section of the report. Now it's telling me percentage of accounts with delinquencies, limited revolving credit available, recency of delinquencies. That's really the one I think that killed him. And recent credit inquiries and or new credit. Yeah, his credit wasn't too deep, but that November and September, all of those within the last 12 months, really killed the deal. That's really what did him in. And then the rest of the stuff here is just basic stuff. What you're going to see on every approval.
Yeah, I would caution reading the rest. If you get a refer, you really just want to read the negatives because these positives aren't real. It's refer really. So yeah, these are kind of misleading, right, Jose? These ones.
They're just telling you how it would be possible to document. So yeah, if you got the approved eligible, you could just get by with with 30 days pay stubs and a W-2, like what we were discussing on the file yesterday.
But if you get an approve, it might trigger 2 years taxes and stuff like you might. It's just. I wouldn't trust anything on a refer. You're just looking at the negatives, not the positives on a refer. Really.
Yeah. So since we did have rental property income, so it's telling us how we need the tax returns with the Schedule E. Now this is tricky. A copy of the current lease agreement if the borrower can document a qualifying exception. I haven't seen one yet. The only qualifying exception would be if it's an unseasoned rental, that it wasn't on the tax return because it hadn't been owned yet during the last tax period. Other than that,
I've had a couple where they have an extension. So a valid extension of the current report is a reason for why we don't have a report with it, right?
Correct. Because you don't have to have it because it's not ready. All right, so just a lot. This is all the stuff that we went over yesterday. All of the reasons why. Verifying the assets, the earnest money, all of those things. One thing I wanted to note on Fannie on rental property income. Fannie will only let you use income from a rental property if you have a primary housing expense. That's a lot of people get caught on that one. So if you have a borrower,
go back to that section.
Yeah,
real quick.
Now that one doesn't say it there, but
I know. But go highlight the last sentence. I want to have everybody to understand that it's gonna last sentence.
Which right this refer?
Yep. So every result we see on a DU, guys, is a summary of many pages of selling guide, right? So just because DU's doing you a favor and summarizing 4 pages into 4 bullet points and 2 sentences, they're saying you still need to read the entire selling guide. So that's where Jose is talking about all those little ins and outs of net rental income are going to be there of you must have a primary expense. It's not going to tell you here that you can't use it. They're going to tell you to read the rest of the guidelines. So remember, DU only does you a favor and summarizes things for you, but don't discount reading the guidelines. We must read the guidelines. So when it says read the guidelines, that means we need to continue our research as we move through the loan and read the rest of the guidelines and make sure we check all the boxes, not just the main ones that DU highlights for us.
Yeah, because that's a really tricky one right there. similar to when we're doing our non-QM loans and DSCR, and some of them require a primary housing expense, or else they won't consider the DSCR. Well, Fannie requires a primary housing expense in order to be able to use the rental income that's being reported on the tax return. Doesn't matter if he reported it, paid taxes on it. They don't care if he doesn't have a primary housing expense. They're just not going to accept it.
Anything else you want to go over on
That's
this one?
not really. I mean, this is just a lot of standard jargon observations that are all. Let me see if there's anything in specific here. No, this is all the stuff like what we went over yesterday already, where it's just summarizing everything. But unfortunately, Homer, had some issues with his credit, so we couldn't get a positive resolution to the DU submission. But it's good that we saw how it could happen, how you could think that everything looks so good. You're looking at the basic numbers, and all of a sudden it tells you, no way, Jose, we're not going to approve it. So imagine if you were an MLO and you're like, I don't need to run DU on this guy. This guy is amazing, and you just give him a pre-qual letter and he goes shopping all over town, and he has a realtor lugging him around all over town, and they're putting offers all over town, and then they don't qualify once they are under contract, and he has a deposit, and they're like, obviously we have options here. Our options now would be to go to first to go to FHA, see if FHA will accept his credit, and then
hold on. Let me tee you up here, Jose.
Okay.
So go back to the. Oh, you just exited it.
Yeah. Oh, what did you need me to go on there?
Go back to the result. You can just pull up the result.
Okay, I ran a few of these, so
they should all have refer, right?
Yeah.
So what I want to talk about is if you were at a bank or lender that only does DU, what would you have to do right now?
If I was somewhere where all I had was a conventional loan and I had no other options, tell them, I'm sorry, Mr. Loanseeker. I couldn't get your deal approved. I don't have any other options for you. You're going to have to go down the street.
And what are you going to put on the SOD, the statement of denial there? Can you scroll down to the exact reason there, just so everybody sees? That's what I wanted to highlight. Okay, and then I'm going to tee you up for what you were talking about next.
Tell me when you want me to stop.
Well, right here, the findings, right? So DU is going to tell us why we're not approved. So we can see exactly delinquencies, credit availability, delinquencies. So those are all on the SOD. Remember, guys. Mm-hmm. So you don't have to be a magician and just know exactly what's going on here. DU is going to tell you exactly why we're going to deny this. Now, let me tee you up on the next one, Jose. So where you were going with that. So if we do have other options, what's typically the only other option most banks or lenders have?
FHA would be the only other option they would usually have. They're well, let's say agency, conventional, FHA, maybe VA, and maybe USDA, right, would be their options. Now, we know Mr. Homeseeker is not military, so VA is not an option. He's buying a house in
downtown urban, Miami. That's not going to work.
The nice urban central core of Miami, so it's definitely not USDA. So at this point, I try to do FHA, and if not, then I'm stuck. But there are options in the non-QM world for this loan because those are consumer credit. That's he's perfect on his loan, on his mortgage. His mortgage account is paid perfectly. So and the LTV is 72%, and the credit score is a 636. So here, this would probably be a second tier credit, but it would still be full doc. We would still get the deal.
What they call near miss or alt credit, or there's a bunch of different names that we have for those programs, guys.
Yeah,
there's a bunch of them out there.
Like with one of our favorite vendors, this would be under the prime product as opposed to the super prime product. The super prime is for the guy with the squeaky clean credit with none of these issues. The prime is the guy that has these, 90 days and all that kind of stuff. But really, with a clean mortgage, he may even qualify as A credit because he doesn't have any late pays on the mortgage. So this would be where we would turn a negative into a positive, and just we're playing with it. We can't get it to run. Okay, fine. Then we switch to our non QM hat. We research our non QM guidelines, of which we have many options. Find the one with the best rate that fits for him, and then give him the good news. Give him his pre-approval letter for his non-QM loan at a 72% LTV, probably a 9.5% rate, somewhere around there, and he's going to be happy. There's no prepayment penalty on that option. So a year from now, maybe a year and a half from now, that his credit has had some time to season, he's probably going to be, at a 680, 700, but those late pays will have dropped off enough that we could probably refinance him into an agency loan. And maybe he'll even want to do a cash out at that time to get some of his $200,000+ back.
Exactly. So again, when we were at a bank 4 years ago, our options were to deny Mr. Homer Loanseeker. But that's why we started our own mortgage bank, not a real bank, right? But a mortgage bank. And that's why we want to say yes to Homer Loanseeker, right? So at Mortgage Calculator, we can say yes to this loan all day long. But at other banks or more traditional lenders, they're going to have only the option we saw, and it's going to be a actual denial. They can't do anything. So that's why we love non-QM. We would love to take on Homer Loanseeker and anybody else who obviously deserves a shot. Just the automated system doesn't quite tell the whole story there, right? As Jose said, mortgages are way more important than some medical collection or something trivial like that. Mortgage payments is really where you cut your teeth in the non-QM world. And what that also means, though, Jose, what I want to go over, what happens if you miss a mortgage payment? That's where we get in big trouble there.
Yeah.
But we have our prime and super prime and other things where we can miss 130 or 160 or whatever it is.
Yeah, absolutely. It's going to be LTV based. LTV and rate, interest rate, and LTV up to a point. So you're going to have your A credit, your B credit, your C credit. And if you go to the grid of whatever conduit you're using, you're going to see what that means. I mean, I've had a borrower with a 625 score with a lot of issues like this be A credit, because A credit means 0 times 30 in the last 12 months on a mortgage. No actions against their mortgage credit events in the last 36 months, which means no short sale, no deed in lieu, no foreclosure within the last 36 months. That's an A credit, even if they have collection charge-offs. And they treat the collections and charge-offs different. That's where it would be either super prime or prime in that one conduit, because in the super prime, they'll tell you any collections over aggregate amount of $2,000 need to be paid at closing. In the prime, they'll tell you you can leave them paid at closing as long as you count 5% of the balance towards a monthly payment and you have reserves to cover the amount of those collections. So if he had $30,000 in collections, but he had $30,000 left over in reserves, and we get that 30,000 times 5% and add it to get that number and add it to his DTI as a monthly payment, and he still qualifies, then the loan is approved.
Whereas conventional, we gotta get rid of those, right? They gotta disappear. They gotta be paid or satisfied or whatever it's gonna be to get them off that report. So
that's the thing about automated underwriting is could help you, but it could also hurt you if you can't get the approval and you can't figure out why is it not doing it. This guy looks so good. Then that's why we have non-QM, which is manually underwritten. We are the DU, when we are deciphering the guidelines and combing through all the guidelines to find the best one that best suits our customer. That's why it's great to be a consultant when you're in the non-QM world.
I just want to touch on one more thing that you touched on briefly, but just to reiterate it, this is exactly why you don't do pre-qual letters, right? This was a great scenario to show, yes, the credit score would qualify, income off the charts, right? DTI super low. So, you can run into big mistakes there, giving people a pre-qual letter. And like you said, you're wasting time, the realtor's time. The client's never going to work with you again. The realtor's never going to work with you again. The seller's agent is never going to want to work with you. I mean, it can be an absolute disaster because you thought it was okay to just, give an actual pre-qualification letter without actually running DU. That is why we're, very passionate about that here, right, Jose?
Absolutely, and it could be so demoralizing if you're a newer MLO that doesn't have much of a track record, and this happens to you a couple times. You're going to want to quit. You're going to say, "Oh no, these people are beating me up." But it's. I mean, I hate to say it like this.
Proper planning and preparation.
Yeah, it's their own fault because you have to set the expectations properly for the customer by following the right steps, doing things in the manner that they're supposed to be. You can't cut corners.
Absolutely. Let's see here. I don't see any actual questions. I do see somebody asking, do you guys hire remote loan officers? Yeah, we absolutely do. You can visit us at themortgagecalculator.com/join. And we have all the information about joining as a loan officer at themortgagecalculator.com/join. Harriet was saying it's best to have no surprises before going house shopping. Exactly. That's why we definitely want to empower our clients with an actual pre-approval that's been actually approved eligible.
And if it has to be non-QM, they know the rates and terms that they qualify non-QM. Because we still will qualify Mr. Homer Loanseeker. I promise you, Jose can qualify Mr. Homer here under a non-QM program.
And in talking about the relationships and empowering people, we're also talking about empowering our referral partners. In other words, the real estate agents. If they know that your pre-approval is solid because you did all of the necessary legwork, that's a game changer. That's what's going to increase the volume of your business. That's what's going to spread the word about you being the consummate professional. Next thing you know, that realtor is so happy with your professional, diligent service that he's referring you other real estate agents that are going to be lining up because you're providing this service, amazing service that, you're not charging anybody up front for any of this. This is in good faith to get the business, and they appreciate that because realtors are not in the business of being tour guides. They're in the business of selling homes and closing the deal and having a happy customer. It doesn't do anybody good if it goes in the opposite direction.
All right. Well, that was perfect. Again, if you didn't get a chance to check it out, make sure to watch yesterday's as well, where it was kind of part one of this, and it will go definitely hand in hand. We do this every Tuesday and Wednesday night, 7 p.m. Eastern. So definitely tune in next week. So thank you, everybody. Thank you, Nick. Thank you, Jose, for the demonstration there. That was great. Hopefully Homer Loanseeker can get his credit together and we'll get him qualified. If not, then we can get him qualified for a non-QM program. That's what we love here.
He really wants that home. He wants it. So we'll just call him afterwards and we'll set him straight.
All right. Thank you, everybody, for tuning in. We hope to see you next Tuesday and Wednesday at 7 p.m. Eastern for the next episode of the Loan Officer Training Series with the Mortgage Calculator. Have a good night, everyone.
Thanks, everybody.
Thank you, everybody.